Welcome to Section 4 of the ASC 505 Equity Training Series. This section covers one of the most practical topics in equity accounting, dividends. Whether your company distributes cash, property, or additional shares, each type has its own recognition rules, journal entries, and common pitfalls. We will also cover stock splits, which look similar to stock dividends but have a very different accounting treatment. Let us work through each one carefully. By the end of this section, you will be able to identify the 4 key dates in a cash dividend cycle and know exactly which dates require a journal entry and which do not. You will explain with confidence why dividends reduce retained earnings rather than appearing as expenses. You will apply the 2-step process for property dividends, including the remeasurement to fair value. You will distinguish small from large stock dividends and apply the correct measurement basis for each. And you will explain why a stock split requires no journal entry at all. Cash dividends move through 4 dates and most preparers know the names, but confusion about which dates require entries is very common. On the declaration date, the board approves the dividend and you record a liability, debit retained earnings, credit dividends payable. The record date is a cutoff that identifies which shareholders are entitled to receive the dividend. No journal entry. The ex-dividend date is a market convention. Again, no entry. On the payment date you settle the liability, debit dividends payable, credit cash, 2 entries across 4 dates. Know which 2. This is one of the most fundamental rules in equity accounting, and it is worth pausing on the logic. Dividends are a distribution of earnings back to shareholders. They are not a cost the company incurs to generate revenue. For that reason, dividends bypass the income statement entirely. You debit retained earnings directly on declaration and credit cash on payment. The income statement sees nothing. If you ever see dividends recorded as an expense, that is an error. The conceptual distinction matters. Paying a dividend is sharing what you already earned, not spending to earn more. Property dividends occur when a company distributes non-cash assets such as investments or real estate to shareholders instead of cash. The accounting has a 2-step sequence, and the order matters. Before you record the dividend itself, you must remeasure the distributed asset to its fair value at the declaration date. The difference between fair value and carrying amount is recognized as a gain or a loss in the income statement right at that moment. This is the one place in dividend accounting where the income statement is affected, but it is the remeasurement that causes it, not the dividend recording itself. Once you have remeasured the asset and recognized the gain or loss, Step 2 records the dividend. At declaration, debit retained earnings for the fair value of the asset and credit property dividend payable. When you distribute the asset, debit property dividend payable and credit the asset, now also at fair value. To make this concrete, an investment carries a book value of $100,000 but has a fair value of $150,000. Step 1. Recognize a $50,000 gain and write the investment up. Step 2. Debit retained earnings $150,000, credit property dividend payable. On settlement, transfer the asset out at its fair value. Stock dividends distribute additional shares rather than cash. Nothing leaves the company, no assets go out the door. As a result, total stockholders' equity is completely unchanged. What does change is the composition inside the equity section. Retained earnings decrease and contributed capital, common stock plus a PIC, increases by the same amount. Think of it as a reclassification within equity. The number of shares outstanding increases, but each share now represents a slightly smaller proportionate ownership. There are 2 measurement approaches, and which one applies depends on the size of the distribution. A small stock dividend is defined as less than 20 to 25% of shares currently outstanding. For small distributions, GAAP requires the fair value of the shares as the measurement basis. The entry is Debit retained earnings for the total fair value of shares distributed. Credit common stock for the par value of those new shares, and credit a PIC for the excess above par. The reasoning is that a small distribution is unlikely to significantly dilute the market price per share, so fair value is an informative and reasonable measure of what shareholders received. A large stock dividend is 20 to 25% or more of shares outstanding, and here the measurement switches to par value only. The entry is simpler. Debit retained earnings for par value multiplied by the number of new shares, and credit common stock for the same amount. No, a PIC entry is needed. Why the switch to par value? A large distribution significantly dilutes the market price per share. Each existing share becomes worth substantially less. Using fair value in that context would overstate the transfer and mislead users, so GAAP requires the more conservative par value basis instead. Stock splits look superficially similar to stock dividends because more shares get issued, but the accounting could not be more different. In a stock split, the par value per share is reduced proportionally as shares increase, so the total dollar balance in common stock stays exactly the same. There is nothing to reclassify, nothing to transfer, no equity composition change whatsoever. The only required accounting is a memorandum entry noting the new share count and the new par value per share. For a 2-for-1 split, 1 million shares at $1 par become 2 million shares at 50 cents par. The common stock balance stays at $1 million. Total equity, unchanged. Let us put all four side by side because the contrasts are instructive. Cash dividends reduce retained earnings and send cash out the door. Property dividends require fair value remeasurement first. That remeasurement touches the income statement. Then retained earnings is reduced by fair value. Stock dividends reclassify retained earnings into contributed capital, but nothing leaves the entity and total equity stays constant. Stock splits require no journal entry at all. And across all four, the income statement is untouched except for the fair value gain or loss on the asset in a property dividend, which occurs in the remeasurement step and not the dividend recording step. Let us close with the essentials. Cash dividends produce two journal entries, at declaration and at payment, while the record date and ex-dividend date require no entries. Dividends in all forms reduce retained earnings and never appear as expenses on the income statement. Property dividends follow a two-step process. Remeasure the asset to fair value and recognize any gain or loss, then record the dividend at that fair value. Stock dividends reclassify equity, small ones at fair value and large ones at par. Stock splits need only a memorandum entry and total equity does not change. Thank you for completing this section on dividends and stock splits. Thank you for watching. Subscribe for more training from P&J Group.